welcome to this Mercia webinar on coping with HMRC Enquiries. I've got a few slides here which hopefully you'll be able to follow. We've also got a set of notes as part of this package. I will make reference to them a little bit as we go through, so if you are looking with the notes or watching with the notes, then you can follow them through. I've tried to keep the points I want to make to relatively discrete areas because this is, having worked there many years ago, it's something which is a subject very close to my heart. So I'll try and make these discrete points, things that we see and come across and which, in which there's a bit of movement at the moment. And the first one I've put up here is the time limits for assessing and for the revenues discovery provisions and so on. Obviously we are looking at a situation where over the last few years there have been both changes in legislation and I suspect for a lot of us changes in case law as well. And you will see within the notes, if you are looking, the basic time limits laid out for which there is nothing particularly new since 2010. And obviously we've got a timescale now whereby the HMRC's general assessing time limit is 4 years after the end of the relevant tax year if they believe something is wrong. Now that is subject to whether adequate disclosure was made or not, which I'll come back to in a minute. But if something's wrong, HMRC have a general assessing time limit of 4 years. Careless is 6 years after the end of the tax year. If it's deliberate, 20 years. So not particularly complicated, and we have fairly static regime for the last 4 or 5 years. One thing which I noticed particularly is the revenue are very poor at keeping on top of those time limits. To give you an example, we've been involved in an ongoing inquiry case where there is a substantial debate about whether something is careless or deliberate, and what the revenue have not done as each company year end, because it's a company drifts by, they have not protected HMRC's position by putting in a discovery assessment. And that means that if HMRC lose their argument, it's not deliberate, it is only careless, then their ability to assess year on year, whether that be company year end or tax year, is falling out. And that amazes me. Certainly when I worked there, which is a long time ago now, but every end of the tax year, we were reminded to look at ongoing inquiry cases and put assessments in place for those years that are falling out of time. And we regularly see now HMRC not doing this. And it is certainly worth bearing in mind what the formal position is. A lot of cases will be settled by agreement, and you overlook sometimes the fact that actually there is no formal way to assess this. So I don't know what the revenues procedures are in this context, but they are very poor at keeping on top of these time limits. The other thing which has changed considerably, and if you're following the notes, you'll see this at 1.2, but is what disclosure means. Now, what I mean by that, if we take the self-assessment process, let's assume your client files on the 31st of January of the given year. I know nobody does this in reality. But let's assume your client is slightly late in the process. So if we take 14-15 tax year, let's assume the client files at the last possible time of 31st of Jan 16. We all know HMRC's time limit for inquiry is nowadays 1 year from the date of submission. However, if there is an error into earlier years' returns, then the revenues start to get into the 4 years after the end of the tax year syndrome. And the case that started all of this, you'll see on the screen, was a case called Veltima some years ago. And Veltima was a valuation case. What had happened is somebody had taken a building from their own limited company. So we had a market value disposal for capital gains by the company. And we also had the individual creating a benefit in kind on the market value of that acquisition. And a valuation was undertaken. Let's say 100 grand was put in the company's calculation and on the personal tax return, and everybody moved on swimmingly. HMRC did not start an inquiry into the personal tax return. They ultimately started an inquiry into the corporate return, sent the valuation off, and the valuation came in a bit higher, let's say 120,000. Now, the inspector was perfectly within his rights to say from the company's angle, well, actually, we've got to amend your capital gains computation to show 120, not 100 as sale proceeds. They then tried to spiral that back onto the personal return, but of course, in our example, the 31st of January 17 had passed. Now, what that then led to was, had the revenue made a discovery? And I think using modern parlance, because this was not a modern case, but there was nothing deliberate in this, and it wasn't careless. They'd undertaken a valuation that had been disclosed within the return. However, the court said that there was not adequate disclosure. There was nothing on the return to allude to a potential loss of tax. Now, I have to say, turning it on its head, you'd filled out every box on the personal return correctly. You would put everything where it should have been. The return does not require you to say anything else, and yet the judge was saying, actually, there is not enough information on the return to allude to a potential loss of tax, that this figure is potentially incorrect. Hold on a minute. The fact that I have taken something from my company clearly alludes to the fact that it is not an arm's length transaction, and therefore clearly alludes to the fact that there is potential debate about what a valuation is. But the judge did not hold that, and this was the groundbreaking case. And of course, effectively what it was saying is you can fill out every entry on a given tax return correctly, as you should do from the revenue's perspective. But if there is any amount of potential that any of those figures is not 100% accurate and sustainable, then the revenue always have 4 years after the end of the year to start delving back and amending that figure. And that was the craziness of this decision. And what it's led to is a number of issues in relation to judgment calls. Do you give information or additional information within the return or not? And a lot of time, I think the client has to make a judgment here, because taxpayers are not obliged to do anything other than fill out the boxes. But if they want to flag this issue up and get finality, they have to allude. Let's take an entrepreneur's relief claim. If there is any element of debate about whether a claim is due, I would suggest the client probably has 3 alternatives. The first one is to do nothing, enter the figures on the return, but if it subsequently transpires something is incorrect, then the revenue potentially have 4 years after the end of the tax year to go back and amend that, not necessarily the 31st of January timeframe. The second issue is to try and put something in the white space and allude to the fact that there is some debate about the claim, but of course the client may say, well, you're flagging me up completely by doing that. The third option is to consider a business clearance, to write to the revenue before anything is done and say, this is the situation, what do you think? But of course, again, the client may say, well, you're flagging me up to HMRC. But I think the important thing from all of this, it is the client's decision where there are areas of debate, whether to highlight the issue and try and reduce the revenue's window of inquiry and amendment, or do you leave it and hope that they fall out of the 4-year time limit and not ask the question? And it's been a big issue. And just to illustrate this, there is a little case in the notes, one of the subsequent ones to Veltima, a case from the late 1990s called Ballystourton, or Staunton, as depending on the pronunciation. And this was a case where the lady had entered into a loss buying scheme. And her advisors, and I will read this for a moment, but her advisors had said, put this wording in the white space on your return and you'll be protected in due course from any sort of issue in relation to this once the revenue gets outside of their normal kind of 1-year inquiry window. And this was the wording that was put on the return. I'm entitled to the loss of £1,003,994.08 under the relevant Capital Gains Act. This is part of a £1 billion loss which arose to a particular trust. I bought my share of this loss for 77,000 quid and so on. So there's quite a lot of disclosure that went within the return. Ultimately, HMRC discovered that she participated in a scheme. By the time they got round to saying the scheme doesn't work, we want to amend your return, they were well out of their year filing date, and yet they said, actually, we don't believe that wording on the return is sufficient to highlight a potential loss of tax. And HMRC won that case. And I think there's a salutary lesson there that if there are debatable areas, the client, if nothing else, has to make a decision. What are they going to try and disclose additional information and highlight it, reduce the revenues window for inquiry, or are they actually going to say, well, we'll take a punt on it? So that was the first area, time limits and discovery and so on and so forth, where there has been some movement over time. The second point I've highlighted is what sort of information can the revenue ask for as part of an inquiry? And you'll see some information within the notes relating to this and so on, and I'll refer to those as we go through. Important to understand, I think now, some of the things we may touch upon as we go through in terms of definitions. HMRC talk a lot about checking returns now. A check is the modern statutory definition of any sort of inquiry or investigation. So if you hear the revenue talking about checking something, we are talking about an inquiry, and therefore all of the things we talk about hold good. The second thing, which I'll come back to in a minute, is statutory records. We'll talk about this in a minute, but the definition of a statutory record is information which people are required to keep, businesses, individuals, to fulfil the relevant requirements of the Taxes Acts. There are obviously time limits, which for direct taxes tend to be 5 years following 31st of January, 6 years after the end of the accounting period. For personal taxpayers, 1 year after the fixed filing date of 31st of January generally. So we'll discuss in a minute statutory records, but a lot of the new legislation is couched around the ability to look at statutory records from HMRC's perspective. The third thing is tax position. When we talk about tax position, what are the revenue talking about? They're talking about tax, penalties, elections, claims for relief, so on and so forth. And there is no debate that in terms of information powers, the revenue's ability to ask for information is very broad, because the definition of tax looks at past liability, present and future liability. And I think this is where some of HMRC's confusion starts to enter into things, because there is no doubt that is an extremely broad definition. For a lot of clients, for a lot of taxpayers, that definition will be limited considerably, and we'll look at that in a minute. And I don't quite think that HMRC understand the limiting effect of how the legislation is designed to work. So we'll look at that in a moment, but there is no doubt it's a broad starting point. Question we get asked quite a lot just before we look at the formalities is in relation to computerised record keeping, backup discs and the like, because the revenue regularly asks for this now and say, can we look at your computerised records? And in terms of law, you'll see this at 1.3. HMRC amended the legislation some years ago now to say, actually, where we've got information powers, so in situations where people are requested to produce information, anytime you read record, include computerised record. So everything we're about to talk about would apply in the same to a paper format or a computerised format. Computerised as such isn't actually defined. So the revenue have a list. We think it's hardware, we think it's software. I've put emails on. It'd be very interesting whether we ever get a case saying, I want to see that email trail. The legislation allows the revenue to obtain access to computerised records. Because it's not the revenue's computer, they say, actually, we can't actually use your computer, but we can say, please, will you show us it? And we can require you to produce somebody to actually undertake that operation. If you don't, you can be fined for the privilege. So in terms of technicalities, if you see paper, please read computer. Okay. Having said that, what does the legislation actually do? And I've paraphrased the legislation slightly and highlighted some words and underlined certain elements and so on and so forth. But you'll see that if push comes to shove, HMRC have a formal ability to require information. Just to blank that for a minute, the one thing to appreciate is in virtually every case I've ever seen, the revenue will not use their information power immediately. You will get a letter, usually, which says you're under inquiry, this is the information we'd like, this is where we'd like to see it, and by this date, and so on and so forth. That will be an informal request. It will not be an information notice, a Schedule 36 notice immediately. So there is usually some wriggle room at the start of these things to say, actually, there is an element of negotiation. This is not a formal power being used at the moment. If the revenue do get to that formal power, what they can formally do is the following. They can formally require you to provide information or produce a document which is in their power or possession. I've highlighted there the word provide. We were asked about a VAT visit recently, and two issues came out of that. The revenue wanted 4 years worth of information on a disc. Can they force you to give it on a disc? Ultimately, we've already seen, they can force you to give it in a computerised form. Now, there's a lot of arguments to go around that, but the first thing is, yes, they can. If push comes to shove, they can. The second thing, they wanted that disc delivered to a building which was nowhere near the client. Now, in theory, the information notice could say, we want you to provide this information at this location. The revenue's guidance is much clearer on this point, and it says, look, if somebody says, come to our premises or pick it up from my accountants, you should normally do that and not specify physical delivery. So it is something, the way the revenue have gone now, they don't have local offices in the same way, they don't have accessibility. Why should you incur the time and effort of getting the information to the revenue? So although strictly HMRC could enforce that, again, 99 times out of 100, it's going to be sufficient for you to say the information is here, please come and get it yourself. Okay. Other things, information or produce a document which is in your power or possession, and this is the big defence to the taxpayer, provided that that information or document is reasonably required for the purpose of checking your tax position. Now again, tax position we said is very broad, past, present, future liability to tax. So there's no doubt it's still broad at that case. However, the first defence there is that it must be reasonable. That request must be reasonable. And I think it's worth bearing in mind what reasonable means. Fair, sensible, logical, proportionate. Going back to that VAT visit, the computerised issue, we could say actually we can't restrict the backup to data relating to the period of inquiry, it's going backwards, it's going forwards and so on. We could raise data protection issues and so on. But my fundamental point is that 4 years worth of information is not reasonable. It is not fair, sensible, logical, proportionate, or in fact anything else. And that is the major defence. Tell me what you really want and we'll provide it, or we'll consider providing it. The revenue are very clear now. They should be highlighting areas of concern when they come. It shouldn't be shake the tree and see what falls out, particularly by giving a disk and doing a data interrogation exercise on it. So the reasonable required is a very big defence, and I think that is worth bearing in mind. Now, as we've said, there is a general right of appeal against these things. However, the rather strange thing is that there is no right of appeal against a request for a statutory record. And we saw the definition of a statutory record earlier on, records which are required to be kept as part of the Taxes Acts. Now, for direct taxes, certainly the definition is very woolly for businesses. Information required to substantiate entries on the return. The personal definition for direct taxation is the same. And therefore you get into this very woolly area. Is a private bank account a statutory record? Well, I don't think it is. If it's a purely private account with purely private transactions, that private bank account is not required to be kept because it doesn't substantiate an entry on the return. The only entry on the return is interest. Therefore, you're obliged to substantiate the interest figure. You are not obliged to give the revenue a private bank account and let them trawl through it and say, what's that deposit, what's that deposit? So it's not a statutory record, therefore you have a right of appeal. There's been a tribunal case recently about a doctor's appointment diary, and the judge, he left aside the statutory point, but he said, actually, I don't believe it's reasonable. I don't think the revenue need this to correlate it to some sort of tax issue, so that request fails. So it is interesting, a lot of these requests, the revenue are not hugely successful for. However, of course, they tend to ask for it informally. And if you're silly enough to give it on an informal basis, the revenue kind of saying, well, thanks very much for being silly. Formally, possibly they couldn't do it. So statutory records is a big deal in the sense that if you get one of these notices for a statutory record, you have no appeal right, even if the notice is unreasonable. Therefore, it's critical to get the revenue's information down while it's in an informal phase. The other thing to note, and you will see this as the notes go down to the bottom of page 3, is that for most taxes, this operates by reference to a kind of return by return basis. So for direct taxation, if I send my tax return in, the revenue can raise an inquiry, they get the information power for that 1 year. If they make a discovery and go backwards, their information power goes backwards. So for businesses and people who file returns, the information power is also effectively limited to a returns by return basis for most people. Conversely, of course, if you've not submitted information and not submitted a return ever, then the revenue have kind of unlimited ability to say, well, I'd like to go back 20 years ago, 23 years ago, and so on and so forth, and ask for information relating to those years. So that is possible. But for returns cases, it becomes very important. They are significantly limited. It is still effectively a return by return process, which becomes important. We've seen a number of cases recently asking for information relating to property. We've been to the land registry, we've seen you've got a property portfolio. We see when you acquired those, or we can see what you've got. We'd like to know when you acquired those, and we'd like to know how you funded those acquisitions. And we're seeing cases where information is going back 5, 6, 7, 10 years. If returns have gone in, the taxpayers are under no obligation to give that information. The revenue had a power year by year. There is no discovery in the sense of loss of tax as far as they can prove, and therefore there is no obligation to provide that information. So it's a big try on some of these, and it's important to me. All I'm trying to get to, you give the revenue the information that you are obliged to give them. You give them no more and no less. The trouble is the revenue will ask you usually for more than actually they can do in a formal sense. So statutory records important, reasonableness important as well in this context. That was the second area that I'd highlighted. The third area that I'd highlighted, again, it came in around the time of when the penalties were amended and when the information powers were amended, and it's this right of access to clients' business premises. We will regularly see the revenue say we'd like to come out and inspect the premises and so on. And the legislation that was introduced, and if you are following the notes, you'll see this 1.7 and 1.8. The legislation which was introduced allows the following. It gives HMRC officials the power to enter a person's business premises. Now, if I just stop there for a minute, it's a right of entry, not a right of search, whatever the difference is. Business premises to me is relatively clear. Specifically, not private premises. That's fine. The revenue's guidance goes on forever and a day about people, let's say, who live above the shop or live on a farm and what is business and what is private. I really can't get too excited about that at the end of the day. Firstly, because to me it's fairly self-evident. A barn is part of the business premises and my bedroom are private, and you can enter one and not the other, fundamentally. So I can't get that agitated about it. But once entered, the revenue have the ability to inspect the following. The premises themselves, the business premises, which I think is fairly self-evident. Business assets on the premises. The definition of business assets are assets used in the business, tangible items, so things like plant and machinery, stock, buildings. Buildings obviously covered within premises, but tangible items, vehicles, and so on and so forth. The final thing that the revenue can look at is business documents. Now, what is meant by this is, again, statutory records. So the revenue have the ability to look at statutory records which are on the premises at the time they come. Which say they're effectively getting a kind of real-time access to statutory records, business records on a real-time basis. You will see, though, if you read the notes, that there are comments against 1.7, references to something called the CH, the Revenues Compliance Handbook, which is a manual that has been written to cope with all of these areas. And I'm just going to illustrate a couple of little, just with that on the screen, it illustrates a couple of things. We cannot search premises, nor can we search, so it's a right of entry, not a right to go around and do what you fancy. We must not use force or subterfuge to gain entry, which I find a quite amazing statement that HMRC have to make to their own officials. You should not hit people or lie about who you are to get in. I find it rather worrying the revenue feel the need to say that in writing. You cannot search, rummage or wander around unaccompanied while at people's business premises. And I think what you start to see, there is a large degree of control you can exercise within this legislation. It is not the revenue can just come in and do whatever they fancy. That is clearly, and the revenue do acknowledge that, and you can see that within their guidance. The general process is that, again, generally it will be an informal request. If they are going to go formally down this route again, there are, I suppose, three possibilities. One is an agreed visit. So HMRC mutually agree a time, place, date with me, and then away we go. The second option, if they can't or won't, is they give you 7-day notice, and that's just 7 days, not 7 working days, that we are coming in a week and a half's time. The third one, which does occur, is unannounced visits. I was reading a case about an unannounced visit to a Thai restaurant where they wanted to come in. So these things do go on. The fundamental point about all of these powers, and you'll see it at 1.8 in the notes, it's an extract of the revenues guidance, is ultimately you do not have to let the revenue in. It's a very strange power, this. They can't hit you, they can't lie, and fundamentally this is my building and I can say no. And you'll see within HMRC's own guidance, it says the taxpayer has the right to refuse you entry. It cannot be overridden, full stop. And that's it. So it's almost a right to ask to come in. And in my mind, it's a bit of the vampire syndrome, I have to say. I've learned a lot about vampires from my children over recent years. As I understand it, if a vampire says, please can I cross your threshold, and you let them in, you could be in really big trouble. If you say to the vampire, you're not coming in, you can't come in. And that is really a very quick kind of way of thinking about this. It is up to you to say, well, we may or may not let you in. If we let you in, we will blindfold you. You'll be led to a dark room. There'll be no heating. You will not leave that room. If you want a wee, bring your own bucket. Yeah, we'll give you a kind of cup of tea, cold, with a bit of dandruff in it. It's up to us to set the terms. If you don't like the terms, then don't come, because actually you can't enforce this. Now, the last thing I would say about this, depending on which route you want to go down, there are different forms of tribunal notice or different forms of entry notice that can be issued. The revenue can issue one themselves. One you'll see up in front of me, the first tier tribunal can issue them. Even if the tribunal has issued it, the maximum initial penalty for saying you're not coming in, for deliberate obstruction, whatever that means, is a £300 penalty. So the punishment for this is relatively small. If it's an HMRC notice they've issued themselves, there's no penalty at all. And all I'm trying to get to, this is about control. I'm not a great fan of letting the revenue in to clients' premises, because that usually means that you've got to be there to contain the revenue, because your client will not be able to. I would rather have the visit at your premises, certain records available, and you can say, we'll wander down at lunchtime, have a sandwich and discuss issues with them. But I think even if you're going to let them into your client's business premises, it's a semi-unenforceable power, this. You have a high degree of control. Please exercise it, because you don't want the revenue wandering around your client's premises talking to whoever they fancy. That isn't what this is supposed to be about. So that was the third little area I'd highlighted. I suppose the final thing, ultimately, make them do it right. Now what I'm getting at here is the penalty regime. There has been a parliamentary committee report on this because of the high error rate in imposing penalties. There are a lot of tribunal cases looking at the new penalty regime, and more often than not, the revenue lose to some extent within their process. And what I've tried to illustrate here is that how the process should work. I think it's important to understand the process doesn't work like this quite a lot at the moment. The parliamentary committee have suggested all HMRC officials who impose penalties need retraining. So you'll see the basic idea is that some sort of document, specified return, goes to the revenue which contains some sort of error, some sort of inaccuracy, and that inaccuracy creates a loss of tax, an overclaim, an overpayment, an underclaim, whatever it may be, which leads to an error, and that error is careless or deliberate. Careless or deliberate is broken effectively down into three strands. And what the legislation is how it's supposed to work is the following. If it's a mistake, there should be no penalty. And I trained actually with the lady who was responsible for implementing this policy, and her view was always penalties are not about raising revenue, they're about education. And I think that now she's moved out of that job, that concept had been lost completely within this new regime. If it's careless, the penalty loading starts at 30% of the potential lost revenue, PLR, the potential loss of tax, the tax effect of that error. If you get into deliberate with understatement, the penalty loading goes up. If it's concealed, it goes up again. There is a separate penalty regime for offshore penalties where the penalty can get to up to 200% of the error. So the principles within each bracket are pretty similar. I will focus on careless. So if I just go back for a minute, I will focus on the careless bracket purely because it tends to be the more common issue that you see. But I think if you go back to that opening slide for a minute, you will see here there is clearly an initial debate, which bracket are we in? Is it careless? Is it deliberate? What is it? So that's the first issue. The secondary issue is then to say, actually, having established which bracket we're in, can we mitigate that penalty? And mitigation nowadays is only by reference to the level of disclosure. So how much you tell the revenue, how much you help them, and so on and so forth. If we stick with this disclosure issue, there are two brackets of mitigation. One is for unprompted, and what this is saying is, if you tell the revenue something they are unaware of, you are clearly going to get more discount than if they tell you and you work backwards. So unprompted, disclosures made at a time when they had no reason to believe that the revenue knew about this error. Alternatively, anything else is prompted. And I would guess for most clients, it's going to be prompted. You send in a return, the revenue write back, say we want to start an inquiry, you work out something's wrong and you negotiate backwards. Well, that's prompted clearly. But it has an effect in each bracket on your level of penalty mitigation. So if we take carelessness as an example, we know that starts at 30% of the tax loss, the tax consequence of that error. If it's unprompted, then in this bracket, the mitigation could be in full, potentially. Okay, so that if it's unprompted careless error, then the revenue could, in theory, mitigate that penalty down to 0. On the other side of the equation, though, probably more common, if the revenue start an inquiry, you accept something's wrong and work backwards, the minimum mitigation level is 15% in law. And what seems to have become very common is the revenue will not argue about the mitigation factor on prompted careless errors. They will say, here's 15%, I'm terribly sorry, that's the best we can do for you. Which is not quite true, but that tends to be the selling point. The fourth strand of this, which would apply to any potential area, is a further reduction, what I call special offers, but special circumstances. The revenue can mitigate penalties further, so below 15%, by taking into account special circumstances. However, their own guidance kind of says, well, don't tell taxpayers about this. This is exceptional. Well, that's not what the law says. It says unusual, special. It is a mitigating factor. So it can go below 15%, but the revenue do not tell people about this fourth strand of the legislation. And quite regularly in the tribunal, you'll see the tribunal say, okay, we accept it's careless, but we do believe there are mitigating factors, and therefore we reduce the penalty further. And what is quite regular now is the revenue will halve that 15% to 7.5%. So the revenue will not tell you about this usually, but it does there, and it is something for you to bear in mind in penalty negotiations. The final strand of this is suspension, and the revenue have created this great acronym to describe how suspension should work, the SMART acronym. And basically what they're saying is, the legislation says that penalties for careless errors can be suspended if that suspension will help avoid penalties for further careless inaccuracies. Not the same inaccuracy, which has been a sticking point with HMRC. Their tendency is to interpret this very narrowly. Just to give you an example, there have been 2 cases over the last 2 years where unrepresented taxpayers made errors within their return. I don't think there was any real doubt that ultimately those errors were careless, and yet the courts have come back and said, well, ultimately you're unrepresented. If you'd had an accountant, we don't believe these errors would have occurred, and therefore our terms of suspension is get an accountant to do your return for 2 years. And I think that illustrates 2 things. Suspension is not about helping avoid the same inaccuracy in the future. It's about any inaccuracy for carelessness in the future. The second thing, the terms are extremely broad. The revenue tend to go narrow. And I think what you'll find for a lot of clients, this is a 5-stage, certainly for careless penalties, because suspension is only about carelessness. But for a lot of penalties you'll encounter, this is a 5-stage mechanical process. Which bracket are we in? Is it careless? Is it deliberate? Is it prompted or unprompted? Is the second stage. The level of mitigation then, down to 15%, is the third. The fourth is special circumstances. And the fifth level is then, can we suspend the balance? And what is very, very clear in cases which I see, in cases in which you see within the tribunal, the revenue do not do this properly. Whether by design or by lack of understanding is not entirely clear. Bit of both, I think, sometimes. But fundamentally, it isn't done correctly. And it is for you have to bear in mind at the end of the day, it is for you to offer a penalty. It is not for the revenue to impose one. So if you're negotiating with the revenue, if they offer something that you don't like, you offer less. They have 2 options, take it or don't. If they don't take it, what can they do? They can formally assess the penalty against which you have a right of appeal, and will see you at the tribunal or in arbitration. So please don't have penalties which you're not happy with imposed on you. I do accept there is a commercial level to this, and you'll say, actually, we can't argue anymore, it's not worth the time. But fundamentally, make them do what the law says. And I think my final slide sums it up. It isn't easy. We have cases on the go at the moment that aren't easy. But at the end of the day, subject to that commercial kind of de minimis figure, you've got to do it right, HMRC. You explain to us within the legislation why you believe what you're doing is correct. And what tends to happen is you get a copy of HMRC's manuals back. No, I didn't ask for a copy of their manuals. I asked for you to put in writing what the law says, please. And the revenue are very, very bad at doing this for a whole variety of reasons, which I don't have time to bore you with now. So good luck in dealing with the revenue, make them stick to their guns, and if you need a point of reference, the Compliance Handbook is an extremely interesting read, particularly if you can quote it against them. So best of British in dealing with HMRC.